Hello and welcome, everybody. Today we have David Morgan, precious metals analyst at themorganreport.com. David Morgan is a widely recognized analyst in the precious metals industry and consults for hedge funds, high net worth investors, mining companies, depositories, and bullion dealers. He is the publisher of The Morgan Report, a world-class publication designed to build and secure wealth. In addition, Mr. Morgan is the author of the Silver Manifesto and a featured speaker at investment conferences worldwide. He has appeared on CNBC, Fox Business, Yahoo Finance, MSNBC, and BNN in Canada. David, the floor is yours. If you need anything, I'll be right here.
All right. Well, thank you and welcome everyone. Thank the Money Show first, Debbie and the whole crew. It's always a pleasure to work with the Money Show. I was at the live event not that long ago in Las Vegas, excuse me, and had a significant turnout. And I was on the finale, the panel of four, which comprised of myself and three others. I don't remember the exact names, but I remember what we're talking about. I obviously was talking about precious metals. The guy to my left was talking about cryptocurrencies. The guy to his left was speaking about foreign exchange, and the guy to my right was talking pretty much private equity. And objective as I could be, because I'm sitting there and taking it all in, I would say that the momentum was definitely between cryptos and precious metals. There wasn't a whole lot of interest, it seemed to me, on the other two, which is interesting, especially from a money show, because the money show takes in money. It looks at everything. I mean, probably geared more toward equities, options, not so much futures, but the stock market in whole, as it should be. I mean, the stock market's been on a tear for quite some time, but I sensed a shift about people looking more toward precious metals. Excuse me. So here's a disclaimer. I'll make some forward-looking statements. Use your financial advisor. This is educational purposes only, and we'll just leave it at that. So, titled Silver's Role for the Next Decade, and that, of course, is, you can say from 2025 to 2035, or you could think of it as from 2020 to 2030. Regardless, the next several years, we have a very interesting setup for the silver market. First of all, as you all know, it's got a dual identity. I mean, silver's industrial demand 25 years ago was 35% of the market. Today it's 60, some say as high as 70. I'll go with 60% of the market. So it's almost doubled in that 25 years. Now, what's interesting is that the amount of silver mined 25 years ago was 550 million ounces. Today it is 300 million ounces greater than that. So think about the math. We went from 35% to 60%, but 60% of a bigger number. 60% of 850 million ounces is devoted to industrial demand, whereas before it was 35% of 550 million ounces. So, as you all know, solar is the prime driver, but so are electric vehicles play into it. Electronics and electricity in all forms, AI, these data centers for artificial intelligence take a great deal of electricity, water, and computing power. And of course, there's always silver involved in anything electrical, electronic, or computers. Now, it also has a role as monetary demand. The word silver and the word money are synonymous in all the Romance languages. And a lot of people outside of North America still consider to be a monetary asset. In the US and Canada, it's pretty much considered to be a hedge against debasement of the currencies. And obviously, it has proven itself over thousands of years, like gold, to be a store of value. Gold is money, and silver is money, plus an extremely essential input for a high-tech society, which we are in and continuing to manifest more and more with more and more technology taking over our daily lives. Just to digress for a moment, how many of you already heard about a newscaster or a blogger or a podcaster talk about how many jobs will be lost to AI over the next few years? So the industrial demand growth, it's gone from a rather modest beginning a decade ago to a huge amount. It's the growth rate has probably slowed, but it's still growing. Projected to be 200 million ounces by 2030. That's a guess, an educated one. EVs to be a couple ounces per vehicle. AI and electronics, 5G, data centers, all. There isn't really a number on that yet. And national security, which is really impossible to ferret out. I've talked about it on some of the podcasts and lectures I've done, that the military use of silver is actually quite substantial. But in the data you'll get from CPM or from the Silver Institute, Metals Focus, any of the studies on the silver market, they just don't break it out because it's held tightly. In other words, if you see brazing, well, some of that brazing is for military purposes. You see it in batteries, well, some of those batteries are for military purposes. You see it in solar. Some of those solar panels are for military purposes. So the data is there, or I believe it is there. It's hard to prove, but it isn't broken out to what the military use is. A lot of weapons use silver, of course, and something to bear in mind. So went the wrong direction here. Sorry about that, folks. Forgive me. I'll get there. All right. There we go. All right. Projected silver demand. You can see this demand curve from solar. As I just said, by 2030, 200 in the last slide. This shows about 240. But it's probably a little inaccurate. I mean, this is conjecture. I had this made for me. It has been growing quite rapidly. Whether it'll stay on that same trajectory, I'll use my cursor here if you can see it. That's the proposed. It may be more along this line here if you can see my cursor. Really don't know for sure. Regardless, it is higher, so I'll leave it at that and advance the correct slide. So silver is used in the electric vehicle market is being adopted, and there's arguments both ways. I mean, the EV adoption took off. A lot of people wanted EVs, and then it's kind of died down somewhat. A lot of the trucks that are EV based just really can't haul. Once you put a load on them, they really don't do a job their truck's meant to do. And so it kind of ebbs and flows like any new technology. It's kind of the early adopters, and then there's kind of a lag, and then maybe some changes are made. The hybrids seem to be coming on stronger. Regardless, they do use more silver. The governments are still pushing toward EVs. And then, of course, there's this whole other area with 5G, 6G, AI. The semiconductor industry uses 44 million ounces of silver on an annual basis. Most people don't know that. So there's a lot of silver, a small amount of silver in the semiconductors, but there's so many, and the production demand, of course, is continuing increasing because silver's conductivity is superior to anything else that we know of, other than save some atom by atom graphene has been shown to have probably as good a properties as silver, but it is not economically viable at this time. And as we all know, it is a critical, essential, non-negotiable metal for the renewable energy and the digital economy. So there's a lot to be said about silver's role, how critical it is for the next decade, which of course is the title of this presentation. And the supply picture. Now, the mine production, depending between CPM and Metals Focus and the Silver Institute, we're somewhere around 850 million ounces a year. What's interesting about that is it's actually been flat for several years. And the reason it's been flat for several years are several. One is a silver mine is a very rare thing. First of all, a pure silver mine where you go into the ground and you pull out silver and nothing else. Those were available in days gone by. The only one that's close to that now is Aya Silver, which is on the Morgan Report list. We put it on, I thought, late, but we're really not too late to buy silver now, actually, although the prices started to move substantially here of late. The miners are undervalued relative to the price of silver and gold. All the mining in the precious metals are pricing their stocks or their companies as if gold is at 2,800 instead of 3,700, and silver is at 32 rather than 44. So if you're late to the party or think you're late, buying the equities is a good way to catch up. So anyway, back on point, it's been flat because silver mines are difficult to find. So they're normally a silver mine or a base metal mine with most of the bottom line due to silver. For example, 25% of the silver market is attributed to copper mining. So these are copper mines that have silver that they use as a credit, but 25% of the above ground supply is a result of copper mining. 35% of the silver supply is a result of zinc and lead mining. Actually, more than 12% is a result of gold mining. So you take that 35 and 25, you're at 60. You take the 10%, and it's really 12 from gold, and you got a 72% as a result of those. It also comes with nickel and tin and others, but those are smaller percentages, but nonetheless. So the idea that you can just jump in and start mining more silver, that's a tough one. Even if the price went to, let's say, hypothetically, $100 an ounce, copper miner is not interested in doubling his copper supply to get the silver out, or as the lead or zinc mine. They're actually more concerned about what's the price of copper. Of course, copper is doing well right now. Lead and zinc, not so much. Gold, of course, is on a tear, but they're not going to change their profile just because silver takes off. And to put a mine in production now is conservatively very optimistically 10 years. It's really more like 15 now. So there could be a huge discovery. In fact, there's a couple on our list that are substantial silver deposits, but they will take years to develop. But if you want to have something, let's say, tucked away in your portfolio for your children or your children's children and have a legacy investment and buy it cheap, buy silver for 5 cents in the ground and have patience. This one particular company I'm thinking of is probably going to be that. But as far as, are you going to see a huge increase in the price in that company? Yes, but not immediately because it's still being drilled out. It'll take a major to come in and further the project. I digress. Let me come back. So production's been flat for a decade. The declining ore grades across the major mines. I mean, I was at Hecla, which is very close to me here. It's about an hour and a half drive from where I'm sitting today. I've been to their Lucky Friday mine a couple times. And when I went over there after I first moved up here, uh, the price of silver was $17 an ounce. They were mining it for about $17 an ounce. And the grades in that particular mine, I'm really not sure of, so I won't misstate it, but very high grade mine. But across the board, on average, the grades keep going down, down, down. So you're mining a ton, but instead of getting 17 ounces a ton, you're now getting 15 or 12 or 10. And isn't every single mine across the board? No, but pretty much. And I said on aggregate, on average, across the board. So you got to do more work. Labor costs are higher. Input costs are higher. So you cost more per ton and you're getting less metal per ton, which means the price just for production continues to go up. And of course, this is arguable. There's really only one industry leader that argues over and over that we're not in a supply deficit. But I think it's pretty easy to say that you're in a supply deficit if the above ground stockpile is going down or up. The above ground supply of silver is going higher, then obviously you're accumulating and you're not in a deficit. If the above ground supply is going down, I don't think you can really argue that you're not in a deficit. And gold, by the way, continually goes up. I mean, all the gold that's ever been mined is pretty much there. It's either in jewelry form or money form or art form. And it just keeps growing every year. And yet the gold market's on fire. And why is that? Of course, primarily due to what's happening in the world of fiat currencies. So I just went through this pretty much where we get the 70% from as byproduct mining and very few, absolute just silver mines, but primary silver mines like Pan American. I mean, their bottom line is a number, and that number is more than 50% due to silver. And the same with other mines. Hecla's like a gold silver mine. It depends on who's who, which metal is relative to the other one. In other words, when the gold silver ratio is very favorable to gold, Hecla's really a gold mining company. And if silver is at, let's say, a favorable gold silver ratio, like say, I wouldn't know the number off my head, but say 60 to 1 instead of 88 to 1, you're a silver company. So that's something, again, to think about, because I'll just add another thing, and that is, if we do get into a global contraction, which I'm arguing that we are, that the amount of lead zinc needed could be less, copper even, but I'm bullish on copper, but not as much as some people. But we'll have to see. But if there was a contraction, then there wouldn't be the incentive to mine as much material because there's not the demand there. And so the monetary demand would probably be shooting higher and higher for gold and silver, but the demand for the base minerals might actually be less, which could mean you'd actually be mining less silver, not more, because the byproduct miners are not incentivized to increase their production. There's no market, prices are falling down, or the demand isn't there. So the inventory drawdown, this can get into a very convoluted mind game if you want it to be. I'll try to keep it simple. The London Bullion Management Association silver is down, and there are various numbers. I subscribe to several services to do my business. One is Nick Laird Gold Charts, and I've known Nick from almost the inception. He reached out to me probably in the year 2000, 2001, somewhere in there. And he does a chart, and you can actually look at what the LBMA reported silver inventory is. What's in the LBMA is down. That's provable. They'll admit it. But some that's there is actually held for the ETF. So you can see a stockpile above ground and say, oh, well, wait a minute, it's really not that low, until you realize how much of that's actually allocated to the ETFs. The COMEX registered inventories are shrinking, but the overall amount of silver in COMEX ebbs and flows. The register was very, very low a few years back. I was actually fairly concerned about it, but not making a huge effort jumping up and down. That has gone up substantially since that time. But the registered category is what is used by the dealer community. So if someone comes in and stands for delivery, it has to come from registered. Everything that's eligible means just what the word says, eligible. It's eligible to be delivered, but it has to move from the eligible category into the registered category. And that's done by basically contractual agreement where the owner of the eligible supply, and it's lots of them. In other words, lots of people, lots of entities, some banks, individuals, investment companies, private equity, I mean, all kinds of things. And they just say, okay, we want to sell it. And so they make their needs known to the CME. They sign a document, and then it gets put in the registered category, and it could go out the door or move in the warehouse with another owner on it. That to say it's shrinking is true, but it's actually gone up. So I don't want to make this convoluted. That's where the supply comes from. And it's usually eaten over time, but it does get down to very low numbers, and then it has built back up. The overall amount in the COMEX is actually pretty substantial, but a lot of that is eligible. So I'll leave it at that. ETFs are not at a peak and vulnerable to a surge in demand. I think that's a more important bullet point than how much is in the registered eligible. Because right now, the amount in ETFs is not that large relative to where we've been in 2020, 2021 when COVID hit. And there was, let's say, a run into the ETFs for metals. Those amounts were superior substantially than what they are now. And now that we see silver and gold doing so well, there is more interest in the ETFs. And I think that's, we'll say, just getting started. The ETFs have been around for some time, but I think renewed interest is there. We know that for a couple of reasons. One, Saudi Arabia just bought into the SLV, the primary ETF for silver, and bought almost 1 million shares. And that's a large amount for you and I, but for the amount of funny money that's floating around looking for a stable home, it's nothing. And so that is just one nation state looking to diversify into silver. The float is tighter than it looks. If you look at the Silver Institute, I did a lecture on this. I won't go through the whole thing here, but Silver Institute reports 3.6 billion ounces of what I'll call investable silver, although about 2 billion of that's in coin form, which is held by retail investors very tightly. This is people that are just savvy to the destruction of a currency, and they bought silver, probably gold as well, to protect their wealth, which it's obviously has done and has done for hundreds, actually thousands of years. So that amount is kind of off the table until the price is, to their liking. Of course, there's always a sale. There's some going on right now as I speak. Somebody's selling because he thinks it's, near a high, or they need the money for another purpose, or they made a profit. They want to move their silver or gold, or they want to move their precious metals out of that category of investment and into a real estate purchase or whatever. So it's not like it doesn't ebb and flow every day. But on aggregate, generally speaking, on the total market, I think the silver market's got to go, past into the 50s or toward that where you really see much more selling than it's already taking place. Retail, by the way, is actually selling more than buying. It's the institutions, it's the industrial side that's buying silver, not the average, what we call silver stacker. Regardless, the float is tighter than it looks because how the investment silver is dispersed. So you got 2 billion, 2.1 billion actually in tied hands in coin form. Of the 1.6 billion, 1.5 billion that remains, 300 million of that is in retail bar size, which is your 100-ounce bars, your kilo bars, your 10-ounce bars, your 1-ounce wafers. So now you're down to about 1.3 billion. About half of that's in the ETFs. So you only have 600 million round numbers sitting there in what I call the float. And if we're eating away at 200, 250, that's 3 years. But in the year 2020, 2021, the ETF went up by 320 million ounces in 1 year. So that would take 2 years of that kind of buying. And you theoretically, let me repeat myself, theoretically, taken out the entire commercial bar, which is really the silver market, the derivatives market, stood for delivery of physical metal. Russia's obviously bought silver and kept it kind of quiet. They bought it for either strategic. I doubt they bought it for monetary purposes, but silver doesn't care. Demand is demand. And they bought a fair amount of silver and platinum well before this market started taking off. Now that it is, again, I think Saudi Arabia dipping their toe in the water may spark other to do likewise. So the deficit debate, as I said, CPM and the Silver Institute don't see eye to eye on the numbers. I've gone over that a few times. You can look at my blog and see what I've written about it and spoke. And Jeff got a hold of me, the managing general partner of CPM. I've known Jeff for over 20 years. We get along just fine. He thought I'd misspoke, so I corrected it and they basically read what he wrote me. Regardless, as I said earlier, is the above ground inventory growing or shrinking? It's really that simple to me. The reality is that the inventories are declining and demand is strong. Retail demand is flat, but industrial demand, institutional demand is strong. Surging may be too strong a word, but it's certainly strong. And certainly the price is surging relative to what we've seen in years gone by, where we just went up and down with the bias toward down for several years and then flat or sideways for quite some time. Supply deficit cannot meet the current demand. I say current because, let's just say for whatever reason, that 2.1 billion in coin form, it's 1.1 billion in government minted coins. That's officially coins, and the other 900 million is in what's called silver rounds or medallions. I mean, you could call them coins in quotation marks because they're privately minted. So if you want to get legal about it, they're not coins because they're not stamped out by a government. They're stamped out by a private mint, but nonetheless, they take a coin form. That's a good example right there. That's privately minted coin, or I should say medallion or round, but basically they're in, let's say, that form. So it's a monetary hedge. Actually, it's one of the better monetary hedges. I think it's superior to gold, even though gold has outperformed silver, and I've always advocated owning both. I've never said, in fact, if you are a member, a paid member, you're a premium member. If you become a member of the Morgan Report, then the first thing you're asked to do is to read how to use the Morgan Report. And that's a PDF I put together some time ago. I've updated it not that long ago about general guidance on how much gold and how much silver physically do you need. And after you've established that, then the amount that's left goes into equities. What kind of equities? Well, top tier, cash rich, unhedged, usually royalty companies, but we have miners as well. This much would be like 70%. So we put big money in big companies. You can write options on there and get an extra almost 20% a year if you want to write covered calls, which is a very low risk way to increase your performance. Certainly, you could own a couple, three top tier golds and silvers and just own them outright and then write or rent your stock on a monthly or 3 month basis. Take maybe 20, 30 minutes per month to do that. Maybe do it every 3 months and still get about at least 17% a year, which is a lot bigger a return than you're getting in the debt markets from US Treasuries. And it's backed by gold. It's gold in the ground. It's not gold you're holding in your hand, but you've already established that if you took the guidance from how to use the Morgan report. So I digress. Come back. This is a pretty interesting chart. I like to use the dollar here, but show you the purchasing power of the US dollar to 2020. Obviously, the trend is down, especially if you look at here in 1970, the gold standards abandoning currencies are no longer. You see that accelerated down. Now we're kind of tapering off what's called an asymptotic curve. Learned that word. I learned it in engineering, but basically you're getting closer and closer to zero, but you're not actually hitting zero. And that's kind of where we've been for quite some time. And of course, the dollar's strong compared to what? Well, strong compared to other currencies. Why? Because the other currencies are depreciating at a faster rate than the dollar is. So if you're printing twice as many units of, um, you know, Y currency, I won't name a nation state, and the dollar's only printing at half that speed, then obviously the Y currency is going to depreciate faster relative to the dollar. So the dollar looks stronger, and it is relative to that currency. Jim Dines, if you're familiar with that name, the original gold bug, used to call it a race to the bottom, like who's printing the most the fastest to see whose currency could be worth less than the next currency. And the reason for doing that, well, there's a couple reasons. One's to pay off the debt. That's one of the primary reasons for the US dollar to do it. But generally speaking, it's to get a trade advantage so that your currency is not as valuable as a dollar. So you get an export advantage to sell your goods to the US markets, which is one of the bigger markets. And then, of course, we've got tariffs, I'm not going to address today, but that factors in now with the new administration. So, currency debasement, you've all heard that. Global accumulation with, silver by Russia. China doesn't export any silver. They don't allow it in Saudi Arabia. China is a little more sneaky about silver than, let me go back. The historical role, coinage, this, when you think about 3.6 billion ounces, I mentioned a moment ago, and 2.1 billion of that is in coin or medallion form, rounds. That's pretty interesting. That's actually more than half of the market that's in investment grade form and not in what I call silver form, which is commercial bars. So if you got, what was it, 1.3 billion in uh, commercial bar form, and the remainder of 3.6 billion is actually either in small bars or coin form. That actually tells you a story that the retail investor actually holds more actual silver in investment form than the institutions. Physical silver is wealth insurance. You wouldn't be listening to this lecture if you didn't know that already. Investor strategy core is to have a physical position. If you're interested, you could contact me. You won't be able to get me today, but you can get in the queue and we could go over. I will give you probably the best price and the best place that you could buy from, and also very liquid on the sell side, which many people don't talk about. Some of these very popular dealers that are out there, if there was a rush to sell at one time, they don't have the bank backing that would be required to sell, 10 million ounces at once. Whereas people that I've got associated with. I'm not a dealer, but I could put you together with a registered investment advisor. It's been a friend of mine for over 20 years and can do pretty good on, can't get you a wholesale, but pretty close. Probably closer to anyone else. If you shop it around and find someone else better, I want to know about it because I don't know of anyone better. I've been in the industry for like 40 years. Anyway, top tier miners leverage to the silver price. Again, you can write calls. The mid tiers and juniors, a higher risk reward. So we talk about 70% in top tier cash rich, unhedged. Then 20% or so goes into the mid tiers. We have junior producers, which are mines that are mines. They are actually producing, but they've got leverage because they can increase their production because their mine's just getting going, or they've got exploration potential on the project or other projects they hold in the portfolio. ETFs and royalties, that's fine. I don't have a problem with that. We talk about them in the morning report from time to time. Strategies, really, there's three. There's conservative, balanced, and aggressive, and it depends, and it's outlined in how to use the Morgan report if you're a premium. So closing thoughts, silver is indispensable for technology, irreplaceable. For monetary stability, if there is a problem with, make up the worst case scenarios, I'm not saying this is going to happen, but it's happened in Argentina. It's happened in Venezuela. It's happened in Turkey. In fact, in the book, The Silver Manifesto, I can't name them all, but that book is probably more than 10 years old now. But when written, I think we had about 8 countries that were rather current that had, bank closures or failures or whatever. I mean, Cyprus comes to mind. So anyway, if in that event, you'd be using silver on the street. I mean, you could use gold, but obviously gold at 3,700 or whatever it is today, 1 ounce is, you're not going to use it for groceries. Whereas silver, you could. Dime is worth what, $3.50 or something like that right now. Silver dime. Why is it 35 times its face value? Well, because it's silver. That's why. So silver is repricing currently. We're still moving upward. It's strong. Again, the retail side is selling or standing watching. Kind of got their jaw open. Oh, silver is over 30. Oh, wait a minute, it's over 40. Relative to gold, it's still cheap. Relative to the monetary debasement, it's still cheap. And if you, again, want to catch the people that bought silver at 5 or 10 or 15, the best way to do is through the equities, but still I advocate what I always have. And that is that you should start with the real metal first. So you don't need to overload, even if you think you're buying it high and you don't have an exposure to the metals. I would, as I always have, say that you should get some exposure. 10% of your total portfolio is probably enough. So that isn't that big a percentage. It's enough to protect you, but it's not so much that you can't stay as your main domain, being an equity investor or a real estate investor or an options trader or a futures trader or a private equity guy or a venture capital person or anything that you do that you're comfortable with and you like and you're secure in that market. But I do strongly believe, as I said for years, that during a currency debasement, especially when it starts to accelerate as it is now, you do want to have a hedge. And the best hedge that we know is precious metals. Gold is the most negatively correlated asset to the stock market. There isn't anything else other than buying puts, let's say, on the S&P or on the DJI, that would be negatively correlated. But as far as an asset class, there's only one, that's gold, not gold stocks, but gold. So there is that. If you do subscribe to the Morgan Report, you just go to the URL. It's on the website as well, at themorganreport.com/join. You can type that in or find it on the website. New members, I'm giving you a 30-minute strategy session with me. It's $1,000 an hour to consult. And I ebb and flow on that. The last banking crisis, I got quite a few in 1 month. People that never bought gold, didn't want to make a mistake. I connected them with my friend I just told you about a moment ago, and everyone had a smile on their face. So you get that, and it's with me, not one of the staff. And once in a while, I might put you off to one of the staff if I get too backed up, but I would get your permission first. But it's almost always with me. If you just want to phone in, you can. There's a phone number there, 480-325-0230. And always the email there, support@themorganreport.com. You can scan the QR code with your phone if you're so inclined. And in this business, you are, as far as I understand it, you are required to give a 30-day good faith money back guarantee. There aren't many in the industry that do that, but, and I'm not saying they're breaking the law. Some of these are Canadian, not. Anyway, we do 60 days. So if you get the 30-minute consultation, you're gun ho, and then you decide, it's not for me. Okay, we're done. That's fine. And that's pretty generous because, well, what's in it? And I've never done it. And, so all those questions are like, I wouldn't say try it before you buy because you have to buy. I'm not going to just take you on your word, although some of you, your word is fine, but that's not the way the business world works. You pay, you subscribe, you get your call. You've watched it for 30, 40 days. You don't like it. Okay, we're done. And no harm, no foul. I'm busy enough. I don't have time to really think about. It doesn't happen often, but it does occasionally. And that's fine. I wouldn't want to twist anybody's arm. It's not a beginner letter. You would not want to do this if you haven't been in the stock market for at least 5 years. You wouldn't want to get into this if you don't have like 50,000 or so to put. I'd say 25,000 minimum to put into the metals portfolio. So let's say 10% of 250,000 is 25,000. So if your portfolio is in that range, then obviously it's probably worth it for you. Now, if you say, I really want to go home, maybe 20% or 25% is more to my liking, and I can make an argument that that's the amount you actually should use, but I'm just going to be conservative, say 10. And you're in that, 25 to 50 range is probably worth it. Anything under that, you'd probably just be better off buying a gold stock mutual fund. And you can find them easily with any search engine, best performing gold mutual funds. And I know, a couple of the guys that run them that are pretty good at what they do. We usually beat them, but ours takes active management. You're going to have to brokerage account. You're going to have to buy the stocks that we tell you. And I would be going over that in the 30-minute get to know, the Morgan Report as we do our 30-minute session. So that is it. I think we got about 10 minutes left for questions, and I'm ready.
We'll try to squeeze in a couple here real quick. Let's see. We have a couple people commenting. Here we go. What is your opinion on platinum and palladium? And what is the yeah, thank you.
Sorry, go
What is the
ahead.
best method to invest in these specific metals?
Yeah, we were pounding the table on platinum. I actually made a lot of people rich. I don't do futures as much as I used to, but about 2 years ago, I was doing a spread trade. Anyone that knows the futures market knows a spread is a very low margin. So it was short palladium, long platinum. And palladium went from 2,000 to 1,000, and platinum basically hung around 1,000. So you only have to be correct on the spread. So the prices narrowed, and I kept that trade on for probably a year and a half. I took the trade off when it got close to par. So when platinum's price reached palladium's price reached platinum's price, I took the trade off, and that was months ago. After that took place, I started to buy physical platinum. And again, we featured the Morgan Report when it was about 950, and we were pretty much pounding the table. In the April report, I said, gold's really taken off. If you want to buy gold at $1,000 an ounce, buy platinum. Platinum is superior to palladium the way we see it. And platinum is 15 times rarer than gold. It wouldn't surprise me over the next 5 years that we will see platinum regain its title as being at least equivalent to gold in price. So 1,000 to 3,000 at the time, somewhere in that vicinity. So we urged people to go flat. I said that gold would be flat all summer long, and it was. And it could go all year, but I'm not sure, but at least all summer, and it did. but platinum's up about 50%. So some of the people that follow our premium service traded gold for platinum or bought platinum outright, as I did, around that $1,000 level. There are ETFs. We talked about a couple of them. There are some platinum mines or palladium mines, PGM mines, platinum group metal mines. And that's another way to do it. I did outline that in um, one of our video updates. The letter comes out electronic form. It's pretty lengthy, but and you only have to read what you need to read. I mean, we cover a lot of companies and we do it alphabetically. So if you have like 5 or 6, like we recommend, instead of everything that's on the list, you just read those that you want or need. Anyway, back on point. Um, I still think platinum has a ways to go, but I think that should answer it. What's your next question?
Which do you prefer, silver miners or silver junior miners?
Silver miners. I mean, in the How to Use the Money report, you put big money in a big company. But there will be a time to speculate with anything silver related. That will come later in the cycle. And some of these, what we call moose pasture, which was really nothing more than some land somewhere in Idaho or South America or Peru, wherever it is, with the name silver in it. And they'll be cheap. People love cheap stocks. They're cheap for a reason. They're not worth very much, but people, especially people that feel they're late to the party, they'll buy, 7-cent stock and it'll go to 70 cents because a bunch of other people will be wanting to get into silver, and 70 cents is less than $1 and they feel they're doing something. So select juniors, that's fine. And as long as you balance the portfolio, the biggest mistake that most equity investors in the gold and silver space do is they buy cheap stocks. There's only one out of 4,000 ever becomes a mine. I had the hot hand on that early on on the internet, and I've lost that hot hand, as others have. But as long as you do it and you understand like game theory or how you gamble and protect your core investments, if you want to speculate here and there, that's fine. If you're buying a bunch of juniors to buy a bunch of juniors, even in a very hot market, you better be very good at your timing because they will do what I call popcorn rally. They'll go from 7 cents to 70, as I just outlined, and they'll do that in 3 weeks. And then the insiders, the promoters that are really pushing it hard, getting a really great video, getting maybe a celebrity to tell you about the silver mine, which isn't a mine, it's an exploration company. People will pour into it, they'll sell into that volume, and then it'll come right back down. So you got to be careful, but that's one of the reasons I'm here, to give you guidance and help you along those ideas.
Perfect. Thank you, David, for your presentation, and thank you all for joining us today. We have more in store. Don't forget to check out the next session. Thank you, everybody.